Hello and welcome. I'm Monica Lobel, National Director of Development for American Friends of the Hebrew University. Thank you all for joining us today. Today we will learn from two experts about the post-election economy and new tax planning challenges ahead. The American Friends of the Hebrew University connects the passions of Americans to the talent at the Hebrew University of Jerusalem, one of the world's most distinguished academic and research institutions. In addition to raising awareness and funds for the university, AFHU helps the university recruit and retain outstanding faculty, build teaching and research facilities, and provide scholarships and fellowships. AFHU's support helps the university advance human understanding in many fields, including agriculture, nanotechnology, economics, public health, law, medicine, and much more. During these challenging days, there are many ways to get involved and keep informed. Please visit afhu.org regularly for information about future programming and webinars that will give you the opportunity to learn about groundbreaking research currently going on at the university, at the Hebrew University of Jerusalem. Today, we are looking forward to an enlightening discussion. Please submit your questions by typing them in the Q&A box, and we will do our best to address them. And now it is my distinct pleasure to introduce our presenters. Professor Naomi Feldman is an associate professor of economics in the Bogan Family Department of Economics at the Hebrew University. Professor Feldman is a public finance economist who studies how individuals and firms react to changes in tax policy. In particular, she's interested in how the complexity of the tax code impacts these behavioral responses. Before joining HU, she was employed at the Federal Reserve Board of Governors in Washington, D.C., and spent a year at the Council of Economic Advisors, CEA, in the Executive Office of the President as a senior economist in tax policy, in addition to adjunct teaching at the University of Maryland. Professor Feldman holds a PhD in economics from the University of Michigan in Ann Arbor. Her predoctoral studies were at the University of Illinois, where she earned a BS in economics and French literature. Thank you for being here with us today.
Thank you.
Neal Myerburg is an attorney and well-known authority on tax and financial planning strategies using charitable giving techniques. As principal of Myerburg Philanthropic Advisors, Neal consults for many of the nation's largest nonprofit organizations and individual philanthropies. Neal teaches the Plan Giving course in the Columbia University Master's Degree Program in Nonprofit Management. Welcome everyone, and we're here for a treat. Thank you for being here with us.
Okay, I should get started?
Yes, Professor.
Okay, great. Okay, a second here. Okay, wonderful. Thank you again for having me. It's a real pleasure to be here. So I'm going to talk a little bit about some of the tax changes that we might anticipate over the next couple of years post-election. And so let me just get started. Okay, so the first thing I'll start off with is that I think it was Yogi Berra that said, you know, prediction is hard, especially when it's about the future. And I think that's all the more true now because we're in a situation with this pandemic that we've never really been in before in terms of federal policies, tax policies. And so a lot of what I say now will really depend upon how the pandemic plays out over the next year. But for the sake of this talk right now, I'm going to assume that things are going to improve. The population will be largely vaccinated over the course of the year, and the economy is going to open up, likely with some remaining restrictions in the near term. And so where do things stand right now? So just to give you a picture of what has happened sort of during this pandemic, here's a graph of the deficit as a percent of GDP. And what you'll notice here is that negative numbers represent larger deficits. You'll see that we really was a free fall come the second quarter of 2020. And so the deficit that we're living in right now is second only to that during and the aftermath of World War II. We all know there were a number of stimulus packages that happened, 2.3 trillion in September of 2020, 900 billion at the end of December, and then the 1.9 trillion package that we're talking about right now and is likely going to pass if it hasn't already. So these are sums of money in terms of fiscal stimulus that we've never really seen before in the United States. When you look at the debt, the federal debt held by the public as a percent of GDP, again, you see that come second quarter of 2020, things just really skyrocketed, really took off. And the debt is just the accumulation of all these deficits. And now, again, we're reaching debt levels that we haven't really seen since World War II. So we're really, in sort of uncharted territory for a non-wartime economy. In terms of unemployment, it's skyrocketed, as I'm sure many of us know, in the second quarter of 2020. It's since recovered quite a bit, but on net, we've lost about 9.37 million jobs in 2020. And this exceeded the number of jobs that were lost, for example, in 2009 during the global financial crisis. So the economy right now is really, and here's just another graph where I just sort of zoom in on that unemployment rates. So the economy is really in a very sort of serious position, I would say. And so there'll be a lot of things that will have to be dealt with in terms of deficit debt and getting the economy back on track. So take that all in sort of the context and the background of the things I'm going to say now, because first and foremost, the government will have to be dealing with a lot of these issues. So what's on the tax agenda? So what we know for the most part are things that President Biden had talked about prior to the election. And we could talk about a little bit whether we think some of these things will come to fruition or whether there's sort of, an opening bid. A lot of times what sort of presidents or candidates say is sort of their opening bid, and then things get negotiated later. So some of the Biden proposals, I divide them into two categories. There were proposals dealing with sort of corporate taxes and those dealing with individual taxes. So in terms of the corporate tax rate, the first proposal that President Biden has said is that he wants to raise the US corporate tax rate to 28%. So prior to the Tax Reform Act of the end of 2017, the US had the highest corporate tax rate in pretty much most of the world, at least in terms of developed countries. At the time, it was 35% corporate tax rate. On top of that, you often had state rates. And so you were looking at rates around 40%. This is far more than the rest of the world. And in fact, corporate tax rates have been falling for the most part over the last couple of decades. So here, this red dotted line represents the average non-US OECD rates. The red bar that you see right here represents where the United States is right now, currently relative to other countries. If the tax rate were to go up to 28%, as President Biden proposes, on top of that, you have sort of an average state tax rate that would once again place the United States as pretty much with the highest corporate tax rate in the developed world. And so this is something to keep in mind. Again, this is one of those, lowering the corporate tax rate was something that had bipartisan support. People were really just arguing over what the rate should be. Should it be 20%, 21%, 28%? And so there is a possibility that it could go back up to 28%. And so I'll talk a little bit more about whether we think that could actually happen going forward or not. There were a number of other issues dealing with corporate tax rates. So the corporate tax reform was incredibly complicated that happened under the Tax Reform Act at the end of 2017. The idea really was that US corporations were for the most part taxed on their global operations. And when they would bring money back to the United States, they'd be taxed on it. If they left money abroad, they would not pay tax on it. And so the US was one of the few countries in the world that had a global corporate tax system. That is, it taxed US firms no matter where they were in the world. Whereas most countries have moved towards what we call a territorial system, that they're only taxing their corporations when they're actually in the country. So if a UK firm, for example, produces something in the United Kingdom, it would pay tax to the UK government. But if that same UK firm was producing something in Germany or somewhere else, it wouldn't be paying taxes to the UK government. And so the US moved a little bit towards this trend, towards this territorial system, but it did a couple of things to make sure that it still continued to tax US firms abroad. And so what the Biden proposals here do is they strengthen those types of taxes. And so President Biden is proposing imposing a 15% minimum tax on companies' global book income, so they can't place their revenues or their profits in the Cayman Islands and somehow not pay taxes on it. And then it also wants to double some of these minimum taxes on profits that are earned by foreign subsidiaries. So essentially trying to prevent US firms from moving their operations abroad, from placing sort of intangible property abroad, and trying to collect tax revenue on these revenues. Another proposal for corporations is this Make It in America. So again, these are business tax proposals that are intended to essentially end outsourcing and promote US domestic manufacturing and job creation. So I would say that the Tax Reform Act at the end of 2017 used more of the carrot approach by sort of inducing and trying to convince US firms to come back and produce in America, to bring manufacturing back and produce things in America. Whereas the Biden proposal is a little bit more of the stick, and in the sense that firms will be penalized by producing abroad. So here, for example, imposing a 10% surtax on profits of any production or services by US company, on top of already the proposed 28% corporate tax rate, providing 10% advanceable tax credits for companies that make investments that will create jobs for workers, implementing strong anti-inversion regulations, and denying firms various deductions for moving jobs or production overseas. Okay, so in terms of the individual tax changes that we potentially could see down the road, so I know Neal will touch on a bunch of these. So most of the changes that we will anticipate deal essentially with taxing high income individuals, and that's where most of the Biden proposals are focused. I'll start off by saying that most of the individual provisions that passed at the end of 2017 do not expire until 2025. And so President Biden has proposed to return to the pre-2017 Act rates for high earning taxpayers, those over 400,000. So returning to the rate of 39.6 versus the 37% where it is right now. Limiting the Section 189A pass-through deduction. So this is a pass-through deduction that allows taxpayers to exclude up to 20% of their pass-through business income from federal income tax. I will say that, you know, as someone who was part of the process when these tax negotiations were going on, everybody was against this aspect of the tax reform. This was really a purely political reason that something like this passed. This was passed in order to, it was included in order to get sort of, you know, small businesses on board, you know, to the extent that corporations were seeing tax reductions. Small businesses also wanted to see a tax reduction. And so this was something that really was put in to sort of placate. But in terms of sort of promoting inequality, this is probably one of the sort of less, I would say, you know, attractive elements of the Tax Reform Act of 2017. Because essentially what it's doing is that it's giving very high income earners tax reductions for their small businesses. The other thing that Biden proposes to do is to tax long-term capital gains and qualified dividends at ordinary tax rates for those making more than $1 million. And then also unrealized capital gains in excess of 100,000 would be taxed upon death or upon gift, as opposed to waiting until the sale or exchange of the assets. I could pause for a second to see if there are any questions thus far.
Not at this time.
Okay, I'll keep going. As I said before, a number of the provisions are going to sunset in 2025. TCJA, this is the tax reform of 2017, repealed the P's limitation that essentially increased marginal tax rates by limiting the deduction for home mortgage interest, state and local taxes, charitable contributions, and miscellaneous deductions. Limited the home mortgage interest deduction, the mid on new mortgages to the principal of 750,000 instead of $1 million. Infamously capped the state and local deduction at 10,000 and suspended miscellaneous deductions subject to the 2% floor. So Biden has proposed to cap the value of itemized deductions at 28% for taxpayers earning more than $400,000, and he supports repeal of the SALT deduction cap.
We do have two questions, actually.
Sure, go ahead.
Does the tax include married couples?
Which tax?
Leah Rose asked, does the tax include married couples?
So all of these taxes apply to both single and married households. Generally, there are just thresholds that are different between the two.
The capital gains specifically is what she was asking about.
As far as I know, yes.
Okay, and
Yes.
the other questions, would these changes apply to the 2021 income?
It depends. It depends. Generally not. Generally, when changes are made, they'll start on January 1 of the subsequent year. Occasionally, things have been made retroactive. When things are made retroactive, it's usually benefits, not so much raising taxes. So I would anticipate that any tax increases would happen at the turn of the year, whether it's 2022 or beyond. I can't really say. Okay, so how can these pass, right? We know we have a very divided government. The Senate is split 50-50. And so many of these policies could be passed upon party lines. They can be passed under what's called the budget reconciliation process. And so essentially what this means is that generally this is a process that's used when one party controls the White House but does not have a 60-vote filibuster-proof majority. We've seen the parties, for example, in the ACA in 2010, the TCJA, the Tax Reform Act in 2017. Essentially, that these can be passed upon party lines if one of the party has enough, it doesn't have quite those 60 votes. One of the problems with passing things under the budget reconciliation process is that they're subject to what's called the Byrd Rule. And so this means is that nothing that passes now, just to sort of summarize it simply, that increases the federal debt beyond the 10-year forecast window. So this is why this is sort of a trick that you see a lot of governments playing. Why did the Bush tax cuts expire? Why did the Trump tax changes expire? Because they can't increase the deficit outside of that 10-year window. And so one way to get around that is just to have them disappear by the end of that window, and then you go back to the old taxes. So this is something that the Democrats could use to pass many of their policies. It does rely on them having essentially 100% support of all of the senators, support raising the corporate tax rate above 25%. So it's a tenuous process, but it's not impossible. I'll just take one more minute. I'll just say one or two words about state and local tax policy. So states have been really hard hit during this period. Not all states, but many states have. Many states have faced a degree of budget shortfall, and they're going to be thinking about how to raise revenue going forward into their 2020-22 fiscal year. So here's a map of the United States. As I said before, not all states have been adversely affected by COVID. You can see some states have lost up to 10% of the revenue, but some states have actually done well. The purple states here have actually done quite well. And so some states have looked for ways to raise money. Some of them relied on things that worked during the 2009-2008 crisis, 2008-2009 crisis. California, for example, has adapted net operating loss suspensions and credit limitations. There's been some temporary tax increases that have become less temporary. So for example, in New Jersey, they've extended and increased corporate surcharges. Some states have likely seek to raise revenue via the individual income tax system. New Jersey has recently passed a millionaire's tax. Other states are looking to increase rates on high earners. Arizona, California, New York, Colorado, and Illinois failed. In Illinois, they tried to pass a progressive state tax. It didn't pass. And so, as I said before, the pandemic has not had negative impacts on everyone. Some individuals and businesses have really prospered during this time. And so one idea that also has been floated is this sort of idea of an excess profit tax. So this is a tax that was used sort of in Colombia, post-drug wars, in World War II, in European countries. And this idea that people and businesses should not be benefiting from the hardships of others. And so they essentially apply these sort of excess profit taxes on profits made during this period. And so I'll just finish up there. There's a lot of interesting stuff happening in international taxation. I don't have time to go there. So just to summarize, We should expect some changes under the budget reconciliation process, but most likely before the midterm elections. Most likely we'll see tax increases on those making more than $400,000 a year. Expect some states that really have been adversely impacted by the pandemic to seek revenue sources. And how this pandemic plays out over 2021 will play a major role, especially in state and local taxation. And deficit and debt will become much more important as interest rates begin to rise over the next decade. Not immediately, but eventually. And so we'll have to take those a little bit more seriously. So sorry for going over a minute, but I'm done.
We actually have a couple of questions for you.
Sure.
So is the deductibility of interest in state and local taxes subject to the 28% limitation?
So this is a proposal so right now, the Tax Reform Act of 2017 is still the law. And so the SALT deduction is still subject to that $10,000 limit. President Biden is proposing to sort of scrap that when it most likely, I'm not sure if you can override it or when it sunsets, and replacing it with just a cap of this 28%. But that is not the law right now. And again, these are proposals. It's not quite clear that all of these things will pass. It's not clear that he'll have the votes to pass a lot of this stuff.
Sure. The next question is there any prediction on inflation?
So inflation has been stubbornly low for a very long time. And this has been one of the puzzles that, the Federal Reserve banks have tried to deal with. Essentially, the global sort of central banks have tried to deal with is that, why does inflation stay so low when unemployment, for example, is getting, again, talking pre-COVID was so low, where are those inflationary pressures? So there are a lot of academic papers that, some sort of blame the internet that has really lowered prices, put so much downward pressure on prices that it's sort of overriding any other inflationary forces that we would see. But governments are they're desperately trying to get some inflation, because what you don't want to do is find yourself in a situation like Japan where you have deflation, and then you get stuck in this rut for decades and decades and decades. Where nothing moves. And so deflation and being very close to that is actually much more dangerous than inflation. So I know there's been a lot of discussion now about these very large stimulus packages and they could lead to inflation. But I think there are many economists who would actually welcome that, because we know how to deal with inflation. We have standard tools how to deal with inflation. We've just been having the opposite problem right now. But at least in the near future, I would say near to mid future, it doesn't seem like it's moving.
And just one final question about capital gains. If your spouse dies, do you pay capital gains tax?
So there are exemptions under the Biden proposals for charitable contributions and spousal, donations or passing over to spouses. So most likely not. But again, these are proposals. And right now, under the current system, yes, you can give you can pass your estate to your spouse without capital gains taxes.
I think that's all the questions we have.
Okay, wonderful.
Thank you.
Thank you very much. And now we go on to Neal Myerberg.
Let me share my screen. Right. Sorry. I'm glad to see everybody. I'm sorry I'm getting a little slow starting up, but let me just go right to the concept we're going to talk about. Following up on Professor's comments about the economy, I want to talk a bit more about the tax changes I see and others see with respect to estate planning and philanthropy, but particularly estate planning. We know, as you can tell by this slide, there were campaigns based upon a number of issues, particularly the way, as I show out here, how families are going to be able to transfer assets to heirs. So the income tax changes about raising the highest rate, maximum rate for certain people by extending the portion of the Social Security tax to earnings over a certain amount are all relevant, obviously, to high-end people. And the fact of calling for capital gains rates to rise for taxpayers, also for people over $1 million, rates will be considerably higher for those individuals, and planning is going to be really essential wherever tax rates wind up for capital gains. Well, the issue about estate taxes is becoming more difficult to get our heads around. So let's think about it for a second. The idea of overhauling taxes around wealth transfers and gifts and transfers after lifetime can be very difficult if we realize where we are now. Now, two things are to be thought about is number one, the idea of the step up in basis. The law has been for a good while that if you pass assets at the end of lifetime to the next generation, to heirs, I'm not speaking of spouse in this case, but to heirs, the heirs take the assets at the date of death value, which means they get a step up in basis. So their capital gain will be measured from a sale based upon what it was worth at the end of lifetime. Always very good planning. If you didn't want to sell assets during lifetime and pay tax on gain, but you wanted to pass them to next generation, it passes through your estate, and any realized gains would be subject to tax in the new rule. So if there's no step up in basis, and your heirs receive the assets and sell the assets, they would be taking tax or paying tax on your basis, and that could be considerable. Of course, we don't know what the rate would be, but the rate for capital gains taxes might be more severe than the rate for an estate tax. Number two, and this is essential, we have had graduated abilities to exempt estate amounts and gift amounts. Now for 2021, $11.7 million per taxpayer, or double that for a married couple end of lifetime, is the amount that could be given away during lifetime collectively or after lifetime in an estate. And there was the ability for there to be the unused portion taken over by the surviving spouse. If we're going to follow what seems to be the discussion now, this is going to be reduced to $3.5 million in date of death transfers and $1 million in lifetime gifts. And once you exceed these thresholds, the gift tax and estate tax rates will be 40% or higher. So you can see how considerable the change will be in estates, particularly since the estates that will be exempt will be at a much lower level than they are now. Having said that, what can one do? Well, number one, of course, the law is $11.7 million now during 2021 per person. And there is evidence that there will be no clawback in the event you take advantage of that during 2021. If you believe, in fact, there will be changes and reductions going forward beginning in 2022. So you might want to start thinking about moving some assets from the estate to beneficiaries during 2021, knowing that the law will allow it then, and that if the law does change, they won't claw back and look for the taxes as if the law had changed previously. You may also want to accelerate income in 2021 in case marginal rates get higher in 2022. As Professor Feldman said, it's likely that whatever tax laws are changed for this year will take effect beginning in 2022. So 2021, as we see the year go through, is going to be a case for whether or not you should take income and take other tax matters in 2021 before changes occur. And of course, if capital gain rates are going to be increased in 2021 for 2022, we want to try to get rid of some of those gains. Any number of ways to do that, but a principal way that many of you know is take some of those highly appreciated shares and create a donor advised fund, or create an endowment fund, or create your own private foundation, make a charitable gift, buy a charitable gift annuity, create a charitable remainder trust. All these are concepts that will enable you to avoid taxes on gains, either presently or over a period of time, and a deduction for the full value of the stock. So 2021 is going to be a challenge. We don't know what's going to happen. We do know what the disposition is of the administration in terms of taxes and in terms of estate planning, and we've got to really be aware of it. This is a year when you're going to want to spend a great deal of time talking to your estate planners, your accountants, your attorneys, and taking advantage of the concepts that are available, either philanthropic or not philanthropic, in order to make some changes and take advantage of what now exists. Now, we have several concepts that came about from the various acts that have occurred since 2020, the CARES Act, the Secure Act, and this new act called the Consolidated Appropriations Act of 2021. And interestingly, for 2021, those of you who don't itemize your charitable contributions can now take on your return $300 of deductions for individuals. And this was not there last year, $600 in deductions for joint filers. So you in fact are getting some kind of an itemized deduction in quotes, even if you don't itemize. Number two, and this is valuable because they extended this into 20 and through 2021, you can still make gifts of cash to charity and deduct up to 100% of your adjusted gross income. The universe was 60% before this, became 100% in 2020. It'll be 100% in 2021, which means that gifts of cash can be deducted in a much greater amount than they were before. And that means tremendous tax savings for 2021. And if it continues for 2022, we have no reason to believe that either this or this will be continued in 2022, but it really will depend upon what tax policy looks like and economic policy looks like during the course of this year. This is important, and many of you have been paying attention to this. The idea of passing retirement assets, IRAs, 401ks, anything that is a qualified plan to the next generation was always based upon the proposition that the next generation would take these assets, the inherited IRA, for example, and receive it actuarially over life expectancy, therefore take less over a longer period of time, and therefore pay less ordinary income tax. Well, the law has changed, many of you already know, and now there is no more stretch. The IRA has got to be removed, we'll call it an IRA generically. The money in the IRA has to be taken within 10 years, no more than 10 years, in distributions, so that at the end of that period of time, all of the IRA will have been received and all the taxes having been paid. Does two things to an estate plan. Number one, it increases the income tax costs as a consequence of the passing of the asset. And number two, it may belie the plan you had to have this amount payable over life expectancy of your heirs, as opposed to a quick 10 years. And there is a solution among many, but the solution we're talking about and have been for years is using a charitable remainder trust, which allows your heirs to receive the asset value in an income stream for life or lives. Now,
Neal, we have a question.
Yes, of course.
Would the elimination of the step up in value apply to donations made to charities from tax deferred accounts?
Well, if you're making a donation to charity from a qualified plan, which is what I think you're talking about with tax deferred accounts, maybe the tax deferred account is not a qualified plan. I don't really know the base of the question, but any contribution you make to charity will be made at its value, and there'll be no tax on the gain. If that's the question, I hope I've answered it correctly. So on this screen here, I'm summarizing the points we made. The standard deduction increase, the itemized deductions to 100%, the contributions of 2021, if you establish gift annuities or charitable remainder trust with cash, will still get the deduction of 100%. And this is what we should always say. We're going to have clarifications and technical corrections throughout this year to try to explain what these laws actually say. The inherited retirement asset, the 20-year, 10-year rule now for distribution, is troublesome. I repeated on this slide just to say that for those who wish to leave retirement assets to children, you might consider a charitable remainder trust, because that will enable you to determine the payout to the children over their life expectancies, over their lifetimes, in fact. And it can be done for one child or multiple children. At the end of the term of the trust, whatever remains goes to your charities. But during the term of the trust, they'll be paid much like you had originally planned, paying them during the course of their lives as opposed to a term certain. Now, how do you deal with the stretch removal? Now, we have to understand there are some exceptions. If you're the surviving spouse, no issue. If you're a minor child of the IRA owner, not a grandchild, 10-year rule doesn't apply until that child reaches majority. An unusual scenario, a child that young, but it's possible. So if that child is the beneficiary of the IRA, no stretch, the stretch rule only applies when that child reaches, in this case, age 18. Number three, if the recipient of the IRA payments is less than 10 years younger than the original owner, no stretch limitations. And lastly, if someone is disabled or chronically ill, and there's definitions of that, these are the things you might want to know in terms of planning. But most people are grappling with the fact that we're passing IRAs to the next generation of children who don't fit into any of these categories and are going to be limited to the 10-year rule. Now, let's talk about the Ira Charity Rollover for a moment. In 2020, anyone who would normally had to have taken required minimum distributions from qualified plans did not have to. And I think most people, the vast majority of people, did not take RMDs for 2020. So for 2020, without taking RMDs, people obviously didn't have to use what we call qualified distributions from IRAs to reduce RMD because there was no RMD. So it's curious whether there are people who would have normally made their charitable contributions in 2020 because they wanted to reduce tax on RMD who didn't. So we've been thinking about what do you do in 2021 to kind of take care of your charities and take care of your tax payments. And one idea has been, and I've seen it happening already, January and February, that people have been taking IRA distributions to charity, what we call QCDs, in early 2021, knowing that the charity will count them, not for deduction purposes, but for accounting purposes, as their gifts for 2020. So what you've done is you're taking some QCDs in 2021, number one, early in the year, maybe you wouldn't do that normally, and using them to take care of your 2020 commitments. And then later this year, doing your 2021 commitments, again from your RMDs, from your IRA, again with QCDs. In effect, what you're doing is you're doubling your charitable gifts. These are your 2020 gifts. These are your 2021 gifts. So at the end of the year, assuming there will be RMD tax this year, you will have more deductions against RMD and reduce your taxes. This may be applicable to some of you who've wondered how to lessen your tax burden on 2021, when in 2020, your tax burden for that year did not include any money withdrawn as required minimum distributions. The Ira Charity Rollover continues to be the law. It doesn't require renewal anymore. It's the law. Any transfers directly from charity, from IRA to charity, for a variety of reasons and some exceptions, would be eligible for withdrawal from the IRA tax-free.
Neal, we have some questions, if that's okay.
Of course.
So how will the inheritance of real estate expect to change?
Well, real estate is a capital asset. And if there will be no step up in basis and real estate is left to the next generation in the estate, and let's assume for a moment, no estate taxes because it meets certain limitations, certain exempt amounts, the heirs take it at your basis if the law changes. And in selling it after receipt of it, they'll pay tax as if it were you, which could be very substantial, again, depending upon rate. That's a different question than the question about how it lines up in terms of estate taxes, because it's an estate asset. So there are some issues there to consider. There is a matter called a charitable lead trust, LEAD, which is not part of this presentation, which really may come into play again because it's a way of passing real estate generationally by having a charitable income amount intervene for a term of years so that the growth of the value of the asset, when received by the charity and then been received by the children at the end of lifetime, will have no tax costs for the gain in the estate. It's complicated. Just make note of it. It's worth a question to your advisors or to us when talking about real estate. That's really what we see with real estate right now.
The next question is there a limit on the number of heirs that can benefit from a CRT, like large families with 6 children or more?
That's good. It's a very good question. There is no limit. I will caution that the calculation of the rate that will be fixed in the trust, which cannot be less than 5% by law, at least by law now, will have to take into account the life expectancies of the 6 children, which means the rate will be closer to the low end. And that's why people will use, and I'll show you in a moment, a charitable remainder uni trust, where the rate is fixed, but payments can adjust based upon market performance. But the answer to the fundamental question is there is no limit to the number of heirs that would benefit from the income. There is no limit to the number of charities that will benefit from the remainder.
Okay, 2 more quick questions. Are there limits to charitable gifts of appreciated assets?
There are no limits as such, lifetime gifts, but the limits would be with respect to how you can deduct them over a period of time. The cash deductions available to you now, as I said earlier, are equal to 100% of adjusted gross income. A contribution of appreciated stocks, for example, to charity are deducted to the extent of 30% of adjusted gross income. So if you do the basic mathematics, if you give a tremendous amount of highly appreciated assets to charity this year, and we're looking to deduct them from an income tax point of view, you'd have to figure out how much adjusted gross income you had to be able to figure out how much of the value of those assets you can deduct in 2021, but you have 5 additional years of carryovers. So it's mathematical. It's a thing to discuss with your accountants. You can give as much as you want. The question is, can you deduct all of it over that 6-year period?
Got it. And then does the requirement of distribution within 10 years of date of death and taxation apply to heirs apply to Roth IRAs?
Roth IRAs are free. Roth IRAs are you still have the same application Roth IRAs. You paid the tax already. So when your Roth IRA is ready to be taken, it'll be taken at no tax cost, at least no income tax cost.
Great.
Let me look at this screen with you for a moment. Got to cover a little bit of ground, and again, it'll lead to different questions. I don't think there's any mystery about this slide. I'm talking about interest rates. Professor Feldman was talking about, the fact of inflation, and we know now the Fed, at least at the time of recent conversations, is likely to keep rates low, what we call rock bottom, because they don't think it's necessary to fight inflation at this point. It was recently as today in the New York Times where Fed Chairman Powell and administration people were saying, we're just not going to be bothered by that issue right now. So if interest rates are this low, look at the rates for short-term T-bills and look at the rates for one-year T-bills for that matter, how low they are. And with the IRS discount rate, which is a function of Treasury rates, so low, we have a whole scenario of transactions that can occur that need to take into account how do we get more return, and number two, how do we get more tax-free return? And that's what this is kind of not bad in the scheme of partnering with charity to get these results, which I'm about to show you, because most people at certain ages, when you reach a certain point in lifetime, it's much more valuable to take less risk. The mathematics of taking the number 120 and subtracting your age and then determining how much you should be at risk is really still relevant today. So if this is all the case, we've got to talk about this. And many of you on this call, and I know some of you have done this before and have found this to be a desirable way of taking advantage of both rates and tax-free income and tax deductions by creating, based upon New York rules, because AFHU is a New York charity, how to create income in a charitable gift annuity. Simple summary: you give cash or marketable property to charity in exchange for which charity pays you an annuity for life or lives. It can run for 1 life or 2 lives. It has to run for lives. It can't run for a term of years. The income is protected, the deduction is assured, the tax-free portion is known, and charity benefits at the end. Let's take a look at it. Sorry. Let's take a look at it in terms of a couple concepts. That is, and this is important, when you determine a gift annuity, it's not how old you think you are, it's how old you are mathematically based upon IRS rules, which means you're your age to your nearest birthday. So if you're 7 months for your next birthday right now, and you're contemplating a gift annuity, you don't want to have that gift annuity until you're inside 6 months for your next birthday to get the higher rate based upon your next birthday. Number two, if it's 2 lives, and this is a concept to kind of grapple with. If it's 2 lives, the gift annuity rate is going to be lower than the rate for the younger person because of the IRS concept based upon actuarial data that joint and survivor gift annuities, where people were measured by 2 lives, the people together will live longer than either one of them will live individually. So therefore, the rate for 2 lives, and I'll show you in a moment, it was always lower than the rate for the single life. Makes no sense? That's the rule. Number 3, any charitable gift you make other than a gift annuity is deductible at full value, and you pay no tax on the gain. In charitable gift annuities, since it's part purchase and part contribution, a portion of the amount you use is considered to be gain. It's taxable year by year over life expectancy as an installment sale. It's not painful, but you need to understand there is some gain taxable. Why so many people therefore use cash for charitable gift annuities. But when you have low basis stock and you want to liquidate that stock and pay gain over a period of time, but not the full gain, and get income on that value, you would still consider a charitable gift annuity. And lastly, the gift annuity continues to be paid even if you outlive the tables, which is a good sign because lots of people who have gift annuities for some reason do outlive the tables. Let me show you an example. Here's a donor age 70, and let me be mindful of the fact that the rates are based upon the charity's adoption of tables, which are generally issued by the American Council on Gift Annuities and filed with the New York regulator, as AFHU has done. Simple example, gender neutral donor age 70, male or female, who gives $10,000 in cash to AFHU will get a rate based upon the tables of 5.1%. Now you may say 5.1%, is that extraordinary? Well, it's extraordinary if you're getting 0.1% now. And if you believe, as many do, that rates are going to stay very low, at least through 2025. So getting 5.1% if you're in 70s and you're looking for a build retirement income is not such a bad return. 5.1% means that $510 a year is paid. If this is $100,000, multiply it by 10, obviously. Here's your tax deduction. 31% of the contribution amount is an itemized charitable deduction if you itemize. If you itemize in your federal and state combined rates, or if you're in Florida, your purely federal rate is 25%, you will have saved this much in taxes, $778, which means the actual cost of the annuity is $9,222. And the return, therefore, is 5.5%. But what I think is most compelling now is because the IRS discount rate is so low, nearly 85% of this annuity amount is payable tax-free. The upside of low rates, the upside of low discount rates is that the IRS calculations allow so much of the payments of these annuities to be tax-free, and the tax deduction is much larger. So think about this page as we move forward, how substantial this is, which in effect makes this $510 much dearer because so much less of it is going to be taxable every year when you receive a Form 1099-R. Now, if you're looking at giving the same transaction just to show a comparison and you're 75, the rate is going to be higher. The payments are going to be higher. The tax deduction is higher because life expectancy is lower. But look at this as you go down to the bottom. The tax-free portion for a shorter life expectancy is substantial as well. 85.7% of the amount of each year is going to be payable tax-free. And again, this is shown on a Form 1099-R you get end of year. Now, let's go back for a second because the question may be in your mind of those of you who have not seen this before. How do I know I'm going to be paid? Well, the advantage of dealing with a New York charity is New York has very stringent rules, as does California and New Jersey and a handful of other states. And those rules say that the charity's got to create a segregated reserve account like an insurance company. And that reserve account is only available for payment of annuities for no other purpose, has to be held by a trust company, has to be invested in certain rules, and has to have a surplus. Surplus in New York is 26.5%. And so therefore, when you get to the point of calculating that annuity reserve every year, like an insurance company, you report to the state of New York how much money you have that takes care of the risk and how much more you have in there because of the surplus. The principle is the state of New York wants to be certain that annuitants can be paid even if charities can't pay it going forward. But fortunately, New York has another rule which says everybody who's a charity can't do gift annuities. You have to have duration. You have to have ample assets because the assets of the charity, in addition to the reserve, back up the annuities. So when people ask me, are annuities secure? Are they protected? Am I going to be paid? The answer is, if you're dealing with a charity that has to comply with New York or California rules, you're going to be fine. It's where you're in a state where it doesn't that you may have some concern. The last thing I point out, though, is if you live in an unregulated state and you buy an annuity from a charity that is regulated in New York, even if your state's unregulated, you get the protection of New York because the charity's rules apply in New York.
Neal, do you have time for some questions?
I do.
Sure. So is the CGA annuity rate likely to go up or down after March 2021?
Well, you know, the gift annuity rates are based upon tables and they're reviewed every 6 months. I don't think there's going to be any change for a while off this this bottom, so to speak. It's going to take action where interest rates make considerable leaps because it's not based purely, if it were, I would think otherwise, on the performance of the equity markets. If you base it on the equity markets, you wonder why these rates aren't moving up, but they really are reflective of interest rates. So there's a dichotomy there. Equity markets are fine. Fixed income markets, returns are very low. These are based upon the latter. So it's not likely there's going to be any changes in 2021.
Okay. And is it possible to build in inflation protection in a gift annuity?
You cannot, because the rate is fixed based upon life expectancy then, and it stays fixed. You have no downside, even if rates drop considerably and earnings drop to be being paid, but you can't take advantage of any upside. But you can with the charitable remainder trust, and if we have time in a moment, I'll show you how.
Okay. And then is the contribution partially deductible from current state taxes as well?
Depends on the state. Most states, yes. Most states transport the deductions taken on your federal return into the state, so it would depend upon the state. But in most scenarios, the deduction you take federally, absent AMT issues, is going to be carried over into your state return as well.
Okay. We have two more questions. Wouldn't a rise in inflation cause a rise in interest rates in order to attract buyers of government debt? And wouldn't that send the deficit skyrocketing? If the treasury rates go up to 5%, how would the federal government finance the debt?
It's a better question for Professor Feldman, I believe, than for me, but I would say this to you, that inflation, which is the rebounding from recession, is what we always used to believe would occur. And we always use federal adjustment of rates to make that less of an impact. But in truth, there's no way of knowing this, particularly since it seems to be the consensus that rates are going to stay down to 2025. Goldman Sachs's recent report, as far back as this past fall, suggested 2025. So I don't think there's anyone who can really answer that at this time.
Okay. Thank you.
Okay, Brandon?
Yep.
Okay, let me just take a few leaps with you, folks. I know it's getting late. I'm pointing out, without going through this whole slide, that if you gave stock with a basis of $4,000, $6,000 gain, you get the same numbers, except at the very bottom here, some of the tax-free portion will be instead taxable at capital gain rates. These two added together still get the total of 85.7, something to contemplate. When you're deciding upon doing this, you would probably ask for a calculation both using cash and using stock and see which is most favorable. And I want to point also in this slide, when I go back to the point I made about 2 lives versus 1, if you have a donor whose ages 82 and 80, 82-year-old rate would be 7.4 individually, 80-year-old rate would be 6.9% individually. Together, the rate's 5.9. Why? Because the life expectancy of these two people together is longer than life expectancy of either one individually. Therefore, it's going to be presumed to run longer, and the rate reflects that. The tax-free portion, nevertheless, is 87%. You know, we used to call this, and we still call this, the IRS happiness factor. IRS believes that if you live together, you're happier than to live apart. So therefore, we're going to assume you're going to live longer. That's what affects this rates. And lastly, if you're younger, in this case, if you're young at age 60, and you say, I'm trying to build a plan that will take care of my retirement, which I think will be at age 70, and I need to start locking in some rates and some income that won't be affected by markets or by interest rates or by inflation, for this matter. What can I do? If you made a contribution at age 60, when your life expectancy is nearly 26 years, to AFHU, and you said, I don't want to begin to receive anything to age 70, At age 70, you'll receive a 7% return based upon the initial contribution, or $700. Your deduction of almost 24% will be made at age 60, and your tax-free portion begins at age 70. And I want to point out one thing at the bottom. A flexible deferred gift annuity, which is an extraordinarily interesting concept, is you'll get a schedule on your gift annuity document that says, beginning at age 70 and going to age 85, what your payments would be depending upon which year you elect to begin, so that when you get close to 70, you may say, I don't need the money now. I'd rather wait till 75. You will know already what your payments will be beginning at age 75. So that won't be the necessity of taking it at 70 if you find out in your financial planning that you don't need it right away. Let me just cover a couple quick things for you if you don't mind. I know we're getting close to the end. Two things about charitable remainder trusts. Extraordinary vehicles for planning the movement of capital assets. Real estate, stocks, works of art, things that have definite value, and things that are troubling in terms of your planning. And here's an example I use of just purely appreciated stocks. Individual 75 has stocks owned individually, not in an IRA, worth $250,000, with a basis of $50,000, been advised by her financial planner to sell these stocks, thinks it's too risky, thinks they've maxed out, would rather get something with less risk, paying more dividends maybe, or maybe even going into fixed income. And she says to the advisor, if I do, I've got a gain of $200,000, and based upon the rate at the moment, by the time I pay tax on the gain, federal and state, that $250,000 is going to be worth a great deal less. Doesn't make sense to me. I'll continue what I've got. I'll take the risk. Whatever's left over, I'll pass to heirs. Well, the advisor says, well, let's contemplate this. Suppose we take these stocks, create this charitable remainder trust where charity is the beneficiary at the end and where it becomes a tax-exempt entity at the beginning. And we'll put the $250,000 in stock in that trust. Trust will sell the stock. Trust will not pay any tax on the gain at the time of sale. We'll fix a rate based upon life expectancy and current data we are using for this calculation, 5.5% for life. She'll receive this amount of money each year for life. An income tax deduction now for about a half or so of the amount of the contribution, which will save taxes and makes the net cost lower. This is no longer part of her estate. This is no longer subject to capital gain tax at contribution. There will be no adjustment to the rate, so it can't be reduced based upon performance. And for some people, and this is not on the slide, but to contemplate, to make this transaction a completed circle, one might take some of this annuity each year and make tax-free gifts to heirs or to a trust for heirs to enable them to pay a premium on life insurance on the life of mom, where at the end of lifetime, the life insurance policy pays them tax-free and charity gets benefits tax-free, and the family has thrived and she has thrived by doing tax planning sensibilities now. Very interesting concept. Charitable remainder annuity trust, rates fixed, never changes, payment never changes. But in a charitable remainder uni trust, we've got a little bit more of an advantage. And this is what I want to mention to you in closing because of the inherited IRA issue, the 10-year stretch. In this case, we've got an individual 75 who has stocks, we'll call it stocks, could be a work of art, could be real estate, call it stocks for the moment, who are worth this much with a capital gain built in there of $450,000, low basis, and says, well, you know, I would like to do something to avoid the tax. I want a higher rate than a charitable remainder annuity trust, and I want to participate in markets over years. My life expectancy is almost 12 and a half years, and I'd like to see if I can take advantage of that. Contributes the stock to this kind of charitable remainder trust, what we call a uni trust. Goes in at full value, sold by the trustee, if it's a work of art, of course, whatever it may be, sold by the trustee to reinvest the proceeds to have a strategy, fixes a rate at 7. Why not 5.5? You can have a higher rate, same age with a uni trust than you can with an annuity trust because of the adjustment feature. First year, payment $35,000, 7% times the initial value. Each year, at the end of the year, the trust is revalued. And whatever the new value is multiplied by the fixed rate for the next year's payments. Of course, it could be lower than the prior December 31. It could be higher. We'll know that at the end of each year, and we'll know whether our payments are going to increase or decrease based upon end of year. But the point I want to make is, and this is something you want to contemplate and discuss with your financial advisors this year, because of the absence of the stretch. If you use a charitable remainder unit trust to receive IRA funds, and your heirs, one or any number of heirs, as was asked earlier, become the beneficiaries of that unit trust, and the unit trust rate is fixed at a rate perhaps as high as this, and each year adjusts, you're going to be able to pay your heirs, your children, one by one through each of their lives, an amount that will go through lifetimes as opposed to 10 years at a rate which is substantial and will assure the passage of an asset that isn't limited by the stretch provisions and isn't limited by the fact that they'll receive it quicker than you wanted to at a higher tax cost. Something to think about. We're doing a lot of information now at a short period of time, so I wanted you to be aware of this. I should add, you'll see at the very end screen how to reach any of us here for a confidential or a general question or comment that we can discuss with you about how these things might work in your own financial state and philanthropic planning. Last screen just shows you for samples of AFHU's charitable gift and annuity rates and the tax-free column, which I think is compelling. To summarize, a lot of tax law changes, lots of things to think about. Lots of work still to do to look at what the Biden administration and the Congress are going to do this year and next year for that matter. Lots to look at in terms of where the economy is going to go once the $1.9 trillion in stimulus and other monies get into the system. Lots to look at in terms of whether interest rates start going back up. We can't plan in a vacuum, and we can't plan based upon what has been. We have to plan about what may be, particularly estate planning. So I urge you to make contact early this year with those that you depend upon for advice and to get the best judgment you can about what should be done, or contact AFHU. Here's the website address. There's my personal information. And again, everything we talk about is without obligation, doesn't cost you anything for the information. Calculations and advice is always worth looking for. So I urge you to take advantage of that. And I appreciate the fact you've all been here today. I can say to you, as laws change, as we go through the year, FHU will do more of these programs and give you more information and make it up to date for you. So again, Monica and everybody, thanks very much.
Thank you. Thank you all for participating, and an email will be sent to all of you.